All right, everybody, this is Mitch from New Deal Forex coming at you with a new video on best way to grow a Forex account. So this is just my opinion, so take it for what it's worth. But I've been trading for over a year now, not a ton of experience, I know. But at the same time, I've traded more than the average person. So tried different things, different methods in risk management, spreadsheets, things like that, trying to figure out how to maximize my upside while minimizing my downside, which is always the goal. So this is the way in which a person can maximize their gains, grow their account, even realistically get paid weekly by exercising good discipline and trading methodology. So, of course, the way I trade, this isn't tied necessarily to the trading methodology, but at the same time, I trade at the extremes of a range, meaning the high and low of the day or the high and low of a week. I don't take trades in the middle of a range. That to me is a recipe for disaster because you have to use wide stops. But that video is not about that. It's about risk management. So here we go. How to grow an account. So let's say hypothetically, and I'll walk you through the spreadsheet so you have an idea of what I'm talking about. Hypothetically, let's say you're going to start with an account balance of $500. Okay, so $500 is what you got. You're going to risk. Okay, so my risk, I know the general rule is don't risk 1% of your account. You know, you do what you're comfortable with. Okay, my risk is about 0.08%. All right, that's fixed. 0.08% on a one position. All these numbers that you see are based on 50 pips profit and about 20 pips of a stop loss. All right, so there's that. We'll walk you through. Okay, so you start with $500, you risk 0.8. If you take on one position and get 50 pips, okay, assuming $1 a pip, all right, your position size, your lot size, this is not 0.8 lots. Okay, it's not that. This is 0.08. Okay, I'll type it over here. Okay, 0.08. That's your lot size right here. It's not 0.80 lots. That's not almost a standard lot if you know about lot sizes and stuff. So you kind of have to like know what you're looking at here. I would not do a standard lot on a $500 account. That is a recipe for disaster. Okay, so no, 0.08 lots is about 80 cents per pip. Okay, 80 cents per pip. Okay, it varies from currency to currency, I know, but just assuming $1 a pip, we're talking about 80 cents per pip. All right, so if you get 50 pips on that trade, you're looking at a profit of $40. Okay, that's on your first position. This is a two-position approach. Now, can you add more positions? Of course, yes. If you have a lot of leverage and you want to really just go wild, you know, be my guest. But I don't really feel the need to do that. I have done it, and I won't say there won't be times I do it again. But for this example, we're just going to keep it at 50. All right, so in two positions. So that's your first position. Now, your second position, let's say that your trade moves into your favor. So now you say, okay, well, now I really want to put the pedal to the metal here, and I really want to maximize my upside. All right, I want to maximize the upside. Now, your available balance from the $500, and this is assuming I'm using a leverage of 1 to 50. Okay, because I'm in the United States, so I use a United States-based broker. We're limited to 150 leverage. All right, so let's say your available balance for trading is now 415 because you don't get the whole 500 to reinvest. You only got 415 of actual principal to invest now. So out of the 415, you're now going to risk 0.12% of your account. Okay, now this is not a standard lot. Okay, so your second position, 0.08. Your first position, 80 cents a pip. Your second position is $1 a pip. Okay, the dollar sign really shouldn't be there, but it's all tip. Okay, so we're talking about. Let me just make this clear for you here. So your first position, 0.08 cents. Second position, spell that correctly. Second position, 0.1. Okay, assuming $1 a pip. All right, first position, second position. This is my coward position. What do I mean by coward position? This is the position I watch like a hawk. All right, I do not want, if this sinks like 5 or so pips, your stop loss has to be like just razor sharp. Okay, it has to be just very, very tight. You don't want to have a 20 pip stop loss on your second position. You're losing more than the spreadsheet dictates here. Okay, so you have to make allowance for that. All right, so this is the coward position. This is the one where if it goes against you and you're uncomfortable with it, you get out. Why? Because you can always get back in. So don't freak out if your second position moves against your first one and you find yourself in the negative on the second position. Just cut it and then get back in when you're comfortable with doing so. And if you want to adjust that number where it doesn't have to be $1, maybe you want to do a 0.09 position. That's up to you. That's fine. Okay, this is ballpark math. These are not hard numbers. All right, because when you get with percentages and the decimal place moves back and back, then of course the numbers change. But in any event, so now you have your profit is $49.50. Sorry, $49.80 with a 50 pip take profit. So what do we have? A new balance of $589. Okay, and the net profit is $89.80 on two positions, first position, second position, each getting 50 pips apiece, okay, give or take. Now, this weekly pay is based on 3 trades a week. Let me say that again, 3 trades a week. My trading days are Wednesday, Thursday, Friday, okay? Mondays are hit and miss. Market really doesn't do too much for the most part. You can get a good move on Mondays, but they're there, but I don't make a habit of really trying to look for a monster move on Monday. But Wednesday, really, Tuesdays, Wednesdays, Thursdays, sometimes Fridays. So Fridays can sometimes be a trap day, but you can still make money on Friday too. But this is just 3 good trades a week. This is all that this spreadsheet is based on. All right. Now let's take a look at the losses and see our worst case scenario. Again, this is fixed, so you have to, coming into this, you have to already decide where you're getting out before you get in. So let's say you take your first position at 0.08 lots, 80 cents a pip, and you set your fixed 20 pip stop loss. Look at this. That's only $15 that you lose. Okay. So now your new balance is 485. So let's say you set your first position, you get stopped out, you're down to 485. Okay. So I'll update my balance is 485, 485. And the numbers update themselves. All right. And actually down here too, 485. Okay. All right. So you see there, the spreadsheet automatically readjusts your position sizes. Okay, so you know what you should be taking and what you should not be taking. So, and taking a look now, you got a 45 balance. So let's say you moved your position gets against you 20 pips. If you got a bias and you got caught up in a stop hunt, got stopped out, that doesn't mean you just walk away. Okay, if you know what you're doing and you're at the extreme point of the range, it's not going to go down forever. Now I'm not saying keep going short or keep going long against it until you until you're like 60 pips in the hole. That's not how it's done. All right, but anyway. With a 45 balance, now you see here, risking 0.8% of the account. You're looking at a 0.7. You can round this up or down. So let's just say we want to do 0.7 on the first position, second position. Now, and the thing is with the scaredy cat position or the coward position, as I call it, this one is bigger than the first one. So as you see here, it did go up, but you can still keep this at a flat dollar. Okay, this is the one that really puts you over the top right here. All right, and you can still make a decent amount of money on what's left over. And I'm sorry, you know what? This is wrong. Let me change this. This should not be that. 485. There we go. This is actually wrong. Let me undo some stuff. Sorry. There we go. That's what it should be. All right, yeah, because the math looked funny to me. All right, so 485, and then so that's your principal balance starting out after you took your first position. Then 402 is what's left over if you decide to take the trade again. Okay, with the same bias. So let's say you go long, price keeps going up, or price keeps going down, and get stopped out 20 pips. All right, so then you're down to 485. Then you go again. You're down to 485, and you go take your position, take another position at 402. Let's say you get stopped out again, and then it just keeps adjusting. So you're losing $15. So you're keeping your losses small. So now let me show you the power of this though, and then I'll wrap it up because I don't want to belabor the point. So I like. I'm not one of those guys that takes $20 and tries to turn it into $1 million. That's not how I trade. I think to be serious about trading, like a minimum 500, But let's say for this next example, we'll do $1,000. All right, $1,000 starting out. Now let's go through a trading week to see how that could look. Let's say you're going to take 5 trades in a week. Okay, because every trade you're not going to bat 1,000. Not going to happen. All right. So let's go through this and see what would happen. All right, so we come to the computer on Tuesday. All right, we look for a trade, we find one, we take our first position. we enter in at a position size of 1.6. Okay, so that is not a standard. Again, that's 0.16. Okay, so that's $1.60 per pip. All right. Now let's say this position gets stopped out. So now we're down. Okay, so we take a look. What's our max? If the position moves against us 20 pips. Sorry about that. Then we're down to 970. Okay, so we've taken our first loss. Take that. Take that. All right, let me keep track here. So first trade, loss. Okay. Now we're gonna follow that pair though. Let's say, okay, well this time I think we got stopped out, but now I think I'm at the higher low of the day, so I'm gonna go ahead and take it again. Okay, so we'll go again. We'll take the trade, 970. We take our first position at 1.5, and it actually moves in our favor. Okay, so then we take our second position and we get our 50 pips. Okay, so 50 pips first position, 50 pips second position. Our new balance is this profit, which is the $77.60, plus our scaredy cap position of $96.61, gives us a net profit of $174.21. Okay, that's at a break-even win rate. Okay, that's 50%. All right, so you started with 1,000, but now you've increased your account by $144.21 with a break-even win rate. That's why win rates are overrated. Okay, you're okay. You can win like 20% of your trades and still be successful and make money. Okay, but again, it's about risk management, number one, and just knowing what you're doing. Okay, knowing where to get out and where to get in. So let's do just a couple more. So let's do this. Let's say your third, fourth, fifth, and sixth trades are all losers. Every single one on that you take, they all lose. Okay, so loss, 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 loss. Okay, we'll just do a 10 trade example. That's a decent sample size. Okay, so let's go through it. Okay, your first position, you never added a second one because the trade just went against you. All right, so now you're starting at 1144. Okay, everything updates 1144. All right, so again, let's walk through this here. This is after you lost the first one, won the second one. Okay, so now let's start losing. Okay, so what's our worst case scenario? You take a position, you lose. You're down to 1109. 109, 109. Okay, so that's that one. And then you lose again. You're down to 1075. 75, 75. Lose again. You're down to 1042. 1042. And then you lose again. Okay, and notice you're still not down to your starting $1,000. See the power of that? You've lost 1, 2, 3 trades, and you're still up for that trading term. Awesome stuff. Okay, but coming from percentages. Okay, so you're down to 10, 10, and 10. You're still up $10. All right. So now let's say your 7th, 8th, 9th, and 10th trades are winners. But you know what? Let's lose one more time, just for the heck of it. All right. So we lose again. We're back down. We're negative now. 979. As you see here, I got it from right here. Your new balance is 979. You lost again. 979. All right. So you've only won one trade. You've taken 7 trades and only won 1. Last 3 we're going to win. All right. So here we go. Starting fresh. Now we take our new balance here, 979. We take our 2 positions. Boom, boom. We do good, we win. We have our new balance, 1154. Okay, numbers change, new balance. And this is just 50 pips, all right? We take our next trade, we win again. Okay, now we're up to, so we got first position, second position, 50 pips, boom, done. New position is 1361. Okay, right here, we're taking the profit, net profit here, new balance, 1361. All right. Then let's say our last trade, take our 1361, take first position, second position, 50 pips, boom, done deal. New balance, 1605. All right. And what do you know? We end the week with, we're up $600, but we've lost the majority of the trades that we've taken. over that sample size. So this is with a 40% win rate, okay, which is an F in school, but you've made $600. Like, how did you make the $600? Number one, you didn't add to a loser, okay? If you take your first position and that goes against you by 20 pips, basically establishing another zone of trading, you know, you shouldn't have been adding to it in the first place. And number two, if you added the second position, you didn't let the second position get out of you, get out of control. You can either do that by having you can set it with a break-even stop loss or within a pip or two. And again, this is ballpark, okay? But the key to making these numbers work is this position right here and not letting it run away from you. If you, this one here, this is your tester. This is the one that puts you over the top. This one, this is where you pretty much, for lack of a better term, go all in. All right. But if you let this get out of control, none of this will work. Okay. If this position gets 50 pips down or 20 pips down, and it's a bigger one than this one, you're talking about, then you're in blowing your account territory. All right. So that's the best way I can see to grow an account. And of course, you can just keep on going with these same. You can maintain like a 40 to 30% win rate and still do pretty well using this method. But it's really going to be up to you to mainly monitor that position. So hopefully that helps. And you got some value out of that. Feel free to subscribe to the channel and follow me on Instagram at EEMitchell07, where I post some of my trades. Hope you guys have a great rest of your day. Take care.